Welcome everyone to Vested Interest. This is Shane back for today's Stock Pick of the Day video. It is, was it Tuesday? Tuesday, December 17th. We're going to take a look at Vici Properties. This is out of the real estate sector. This is a REIT. Before we get too far in the video, if you could do me a favor, hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you subscribe to the channel. Hit that subscribe button down below. Join us on this journey to financial freedom. Join the Vested Interest community. Click the notification bell so you're notified whenever we put out any new content. I do this Stock Pick of the Day video series Monday through Thursday whenever the market's open, where we take a look at a company stock like Vici, see if it is potentially undervalued on a day it pulls back. There's also the thanks button down below for those of you who can. It's a way you could buy me a cup of coffee. There's several tiers in there if you click that. Appreciate everyone who can do that. Understand those that can't. Times are tough for all of us. And really appreciate all the subscribers out there. Special thank you to you guys and girls. This is awesome. You guys continue to help the channel grow, and it continues to grow because of people like you. Let's get back to Vici. This is the Vested Interest Stock Screener. This is the criteria we're going to run through in the video. It must meet 5 of 8 to make it onto my watch list. Just because it makes it onto my watch list does not mean I'm investing. It just means I'm interested in doing more of a deep dive into the financials of the company. When then I look at their balance sheet, their income statement, stuff like debt to equity ratios, are their margins expanding? Is their revenue expanding? Are they paying down debt, buying back shares, or diluting you as a shareholder, which a lot of REITs do over time? And some other criteria, PEG ratios, price to book ratios, some other ratios I look at as well to see if a company is undervalued. And then if it meets further criteria, then I possibly add it to my portfolio. So again, just because it makes it onto my watch list does not mean I am necessarily buying any company that makes it that far. Now back to Vici Properties. You can check them out on their homepage where I pulled this information from, ViciProperties.com. That's ViciProperties.com. That is their homepage. Vici Properties Incorporated is one of the country's largest owners of gambling, hospitality, and entertainment destinations. Vici Properties Inc. is an S&P 500 experiential real estate investment trust that owns one of the largest portfolios of market-leading gaming, hospitality, and entertainment destination, including Caesars Palace, Las Vegas, MGM Grand, the Venetian Resort, Las Vegas, 3 of the most iconic entertainment facilities on the Las Vegas Strip. Vici Properties owns 93 experiential assets across a geographical diverse portfolio consisting of 54 gaming properties and 39 other experiential properties across the United States and Canada. The portfolio is comprised of approximately 127 million square feet and features approximately 60,300 hotel rooms and approximately 500 restaurant, bars, nightclubs, and sportsbooks. You can read the rest of that there. You can see here some of the high notes there: 54 leading gaming facilities, 39 non-gaming properties, 127 million square feet owned, 500 restaurants, bars, clubs, and sport clubs. Some of those are obviously inside their casino facilities. Hotel rooms, 60,000.3. 4 championship golf courses, 500 retail outlets, and 33 acres of undeveloped Las Vegas land fills out their portfolio. Now, the reason we are taking a look at them, down 1.47% on the day, we are talking about Vici Properties, ticker VICI. Again, this is a REIT out of the real estate sector. Closed the day at $30.05. 52-week range as low as $27.08, as high as $34.29. They are, let me do the math real quick, but I believe they are within 15% of their 52-week low. So what is it, 30.05 times 1.15, 34.55 would be within 15% of their 52-week low. So they are definitely there. Even if you were to buy them at their 52-week high, they would still be within 15% of their 52-week low. So that is when I like to strike, whenever they are dropping, which they are currently. Well, looks like they might have tried to rebound a little bit at the end of the day. Market cap of $31.678 billion, a beta of 0.96, so they are just slightly less volatile than the overall market. You can see that volatility throughout the day here. PE, price earnings ratio, is sitting at $11.13 per share. EPS, earnings per share, is sitting at $2.70 per share. Their next earnings date is coming out sometime between the window of February 20th and February 24th of 2025. That's right, 2025 coming right around the corner. Forward dividend is $1.73. They are a quarterly payer. Their yield is very high at 5.59%. Ex-dividend date, we just passed it. It was today. You needed to have bought them yesterday on the 16th or before. So if you did hold them on the 16th or before, you should get their next dividend, which will pay out on January 9th. One-year target estimate, at least according to Yahoo Finance, at $35.77, which would be a new 52-week high, according to Yahoo Finance, again, where I pulled this information from. I am not affiliated, just one of the sources I go to for information. Now, I like to look at their dividend yield theory to see if the company is potentially undervalued. To do that, we look at their 5-year dividend yield average, 4.98%. We compare it to the current 5.59%, or over here where it says forward annual dividend yield, 5.59%, same number. And since their current dividend yield is higher than their 5-year average, that does speak to some undervaluation, at least according to dividend yield theory. I like a payout ratio under 75%, though for REITs, typically they pay out over 90% of their dividends. By law, they're saying their payout ratio is at 62.13%, so that is below the 65 or 75% I look for there, and it is well below what they are required to pay out. So they might be doing some sort of special dividend or getting ready to raise their dividend or looking to reinvest some of this capital back into make acquisitions to make that number right. Dropping down, I like to look at free cash flow. If a company has growing free cash flow, typically it makes their books look better. They are able to do some things with that free cash flow, buy back shares, raise the dividend, which I like both of those, reinvest back into the company, make acquisitions, and pay down debt over time, which are all good things to do with free cash flow. December 2021 here, you can see $893 million in free cash flow, up in December of 2022 up to $1.9 billion, up again in December of 2023 they reported at $2.1 billion, and it looks like in the trailing 12 months up again to $2.3 billion. They are repurchasing shares as well. 1.7 million in 2021. In 2022, repurchased 6.1 million. 2023, 4.9, and they are continuing that trend in the trailing 12 months at 5.3 million. So actually, this one is nice, steady, free cash flow growth as well as repurchasing shares here over time. Now, jumping over to stockanalysis.com, this is another source I go to for information. Again, not affiliated with this website, just one of the other sources I go to, and I do recommend more than one source for information so you can make sure the information you are looking at is accurate and up to date. It gives you a back check, right? Don't blindly just trust one source for all of your information, in my opinion. They do have 10 analysts that have taken a look at this. They call it a consensus buy. Low estimate of $30, right up against that low estimate, would represent a 0.17% decrease from where it currently sits. Average estimate of $33.70, that would represent a 12.15% increase from where it currently sits. Median average is $34, or I'm sorry, high average is estimate is $37. That would represent a 23.13%. All the while you could collect that plus 5% dividend yield. I like to jump into statistics, look at return on equity and return on invested capital to see how well a company is reinvesting its capital back into itself. And to do that, we look at return on equity, ROE. I like 10% or better for return on equity, sitting at 11.19%, so beats what I'm looking for there. Now, return on invested capital is a little bit lower than I like at 5.3%. Again, I like 10% or better for both of these metrics. EPS growth, I like 5% or better projected over the next 5 years. They did not list anything, so I can't say whether or not they're good, but they will not get a check. They didn't list revenue growth either. Now, jumping over to their dividend history, as you can see, again, quarterly payout ratio 64.15%, again under the 75% I look for, but REITs typically do pay out well over 75% into the 90% range, sometime even more than that. And they do that in a couple of different ways, whether that's dumping more shares onto the market, diluting the shareholder to raise capital. They also can take it out of free cash flow, and they can also take it out of cash on hand, right? If you got money sitting in the bank account, you can obviously use that to pay out dividends if that's what you wanted to do as a company. Dividend growth at 5.31%, so they are growing that dividend, and it is a high dividend yield to start with, over 5%, so that's a nice combination. 6 years of dividend growth. Buyback yield is negative, so they need to be a little smarter about when they are buying back shares. Shareholder yield is 1.18%, so it is positive. You want this number and this number typically to be positive. Though, like I said, if they're buying back shares and issuing shares, that might be part of the reason they might have a yo-yo effect going on there, where they're issuing shares to executives and then buying back some of those shares whenever they can, and that may give them this negative numbers. They're not worried about necessarily when they're buying it. They're more worried about share count. I can't say that's the case, but it could be. Now, they do pay out off schedule of most companies in January, April, July, October timeframe. I do like that. Not a lot of companies do. Most companies pay out on that March timeframe. Going back in time here, you can see June 2022, they were paying 36 cents. Looks like September 2022, they raised it up to 39 cents. September 2023, up to 41 cents and some fractions of a penny here. September 2024, up to 43 cents and some fractions of a penny. And it actually looks like they might have been down a little bit here in December. Not sure why this one is a little lower than their September payout at 0.4325. Need to look at that, what's going on there. But I would anticipate if they were going to continue this growth over time, it will be in September of 2025 when we get that next dividend raise. Or those of you who own I don't own Vici Properties, so for those of you who do, I would anticipate it being September 2025. All right, back to the screener we go. Understand the business. That's where we started. They're a real estate investment trust that invests primarily in the gaming and leisure hospitality space, right? They're owning casinos, spaces like that. It sounds like they're kind of branching out into some other spaces like golf courses and other entertainment venues, but primarily around entertainment, and a lot of what they hold is around the gambling space. Growing free cash flow, yes, do have growing free cash flow, and they are expecting it into the future. Growing dividend, yes, a little over 5%. Nice dividend growth with a high starting dividend yield, actually. Payout ratio is under 75%, but again, we don't necessarily look at that for REITs, but I did give them a check for it anyway, because even if they were at 90%, it doesn't really matter to me. REITs typically are above the 75% I look for, but in this case, they're under it. Check valuation based on dividend yield theory. Dividend yield theory definitely says they're potentially undervalued. Check there. It is within 15% of a 52-week low. Check there. Return on equity was over 10%, but return on invested capital was a little low. No check there. It's got to meet both. And earnings per share growth wasn't listed, so no check there. We didn't look at price to book because it's not a financial company like a bank or insurance company. So we're looking at 1, 2, 3, 4, 5, 6, and even if you took out that payout ratio, which I don't necessarily care about for REITs, that would still be 5 of 8. 6 of 8 puts them on my watch list. It is an interesting company. I'm a little heavy on REITs. I don't know that I'm looking to be adding, but it might be one that I do more of a deep dive into the financials of to see what's going on with this company. Well, that is really it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the vested interest community. And drop a comment down below. I do personally read and respond to the comments. I am always interested in your questions, opinions, and suggestions for future topics. So if you have a company like Vici you'd like me to cover in the Stock Pick of the Day series, drop it down below. I'll try to work into the rotation on the day it pulls back. And let me know what you think of Vici. Is it in your portfolio? Is it one you're watching? Is it one maybe you're part of the selling and you're purging it out of your portfolio? Let me know. Would really love to hear from you. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. I hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.